Hi, good morning, and a very warm welcome to everyone joining us at FinTech Festival India's digital mega event in association with Niti Aayog and powered by CoinSwitch. I'm Gitanjali Mathur, your host for the day. So we are coming live to you on day 2 of FinTech Festival India, and I'm just as excited as you to be bringing this day filled with interesting and insightful discussions woven around FinTech and allied industries. So what are we waiting for? Let's jump right into some of the very scintillating conversations coming your way exclusively through FinTech Festival India. Our first session of the day is as exciting as it gets. A lot of talks have been made about doorstep delivery of financial products. The Finance Minister of India has talked about it. The Reserve Bank of India has talked about it. And a lot of other industry stalwarts have discussed it. But how real is the possibility of achieving this feat in India? To discuss this very current and talk of the town topic, we have with us Mr. V. Ramkumar, Senior Partner, Cedar Management Consulting International LLC, who will also be moderating this Fireside chat. And joining Ram on this dialogue, we have with us Mr. Suhail, Chief Executive Officer, BharatPe. With that, it is time to hand this session over to Ram to take this forward. Over to you, Mr. Ramkumar.
Thank you, Gitanjali. Good morning, everyone. It's fun to be here. What a time to be here. And what a wonderful guest we have here for this fireside chat. Someone who has grown multiple business lines in multiple avatars across consumer, energy, and of course, financial services sector. A fellow consultant, he led McKinsey's clean tech practice for South Asia and the power practice for India. He's also a mentor at Atal Innovation Mission. Suhail, welcome to this very interesting session. Looking forward to a very interesting conversation with you today.
Thank you very
much. Before I start, a quick intro about myself. I am a senior partner with Cedar. Cedar Consulting is also the parent firm of UK-based IBS Intelligence. IBS Intelligence, as many of you know, is highly recognized for its independent views on financial technology industry. So talking about financial technology, and here we are with the CEO of BharatPe. So Suhail, BharatPe built its model on the whole micro, small, medium merchant ecosystem of India, leveraging the UPI platform. You've grown to actually now almost 75 lakh merchants in the last 3 years. Great story, driving the digital wave. Maybe you can start giving us a little bit of a view on the whole business model of BharatPe.
Yeah, no, I think it's very interesting. When BharatPe started roughly now 4 years back, UPI was already big in the country, right? So most of us were actually using UPI to do payments, at least to friends. But very few shopkeepers, which is what the original intent of the product was, were actually using UPI to receive payments, right? And the logic was simple. For a shopkeeper who was charged a merchant discount rate or a percentage of the money he was receiving on UPI as a fees by the service providers, it didn't make sense, right? So to him, it was like one more card machine, right? And if merchants were in India were willing to pay MDR, card would have been a very, very big use case, right? And it's not sort of become as big as it could have. India is a country which is sort of very comfortable using cash, right? So if you tell a shopkeeper in India that you will get your money 2 days later into your bank account and I will charge you 1 to 2% for that, he will obviously say what is wrong with cash, right? So, and that sort of was the genesis of the idea. The idea was, can we make UPI payments free for a merchant? Because they are already free for a consumer, right? So Ram transferring money to Suhail was already free, and Ram transferring money to a shopkeeper is exactly the same transaction, right? So why can't that be free? And so we launched very weirdly a payment business with absolute clarity that payments is not going to make money, right? So and therefore I think the thinking from the beginning was, if payments is not going to make money, where will money be made from, right? And to us, it was one of two areas or both. One was, can you enable credit to these shopkeepers? Because as we know, a lot of these guys deal in cash. They don't have an income tax return history. They don't have credit history, find it incredibly difficult to get a loan. So can you enable that and sort of help them grow their business? And the second was with the sort of advent of e-commerce and modern trade, a lot of these were losing customers to these two streams, right? So can you help them sort of win back customers through a combination of micro-targeting of consumers, through loyalty programs, which have historically been only associated with large brands, right? So that was the thesis we started with. I think COVID wave 1 was a sort of a big break for us. I think many things happened. One, UPI became sort of mainstream. A lot of people, like my parents who had never used digital modes of payment, suddenly started using their phone. And secondly, I think as we sort of helped some of the merchants avail loans during wave 1 or just before wave 1, as soon as sort of wave 1 relaxed, we realized that the money actually started coming back. Literally the money we had written off because we said shops have closed, there are no way this money is going to ever come back. We started seeing that money came back, right? So that gave sort of the impetus or confidence to us to scale the model, right? So today, BharatPe is obviously, as you said, 7.5 million merchants. We sort of enable transactions worth $16 billion a year. And on the back of that, sort of, we help some of the merchants get loans, right? So far, we've powered roughly 3 lakh merchants on loans.
Wow, very interesting. Yeah. And today we are, Suhail, talking about doorstep delivery of financial products and, talking about India on the edge of tomorrow, right? I mean, and here you are talking about, 75 lakh, 7.5 million merchants. And I'm sure they are actually spread across various cities, right? And you may want to talk about the landscape. You're dealing with the breadth and the length and breadth of the country. Yeah? So maybe you should talk about that.
Yeah. So I think today we have merchants obviously in probably every district of the country. And always has been, but obviously the acceptance of UPI or technology and access of technology in tier 2, tier 3 and sort of like smaller areas was always very, very weak, right? So if I look at sort of BharatPe 18 months back, or maybe 2 years back, just before COVID wave 1, roughly 80% of our transactions used to come from like top 15 cities, right? And we were actually debating whether we should even go beyond the 30, 40 city mark, right? So and COVID sort of completely changed that. We realized sort of digital payments were actually growing faster, obviously from a smaller base in tier 2, tier 3, tier 4 cities. Transaction per store, value of transactions per store was actually higher than what we witnessed in tier 1. I think it was sort of surprising to us at that point of time. I think in hindsight, I don't find it very difficult to believe, right? So if you look at credit card penetration outside tier 2 cities, it's negligible, right? If you're trying to get an Amex is maybe a very elite card, but if you're trying to get an Amex card anywhere in Gujarat out of Ahmedabad, you will struggle, right? And therefore, a lot of people who wanted to pay digitally but don't have cards and the merchants who wanted to take money digitally but did not have access to the card infrastructure, that's actually enabling tier 3 and beyond to leapfrog and sort of become market leaders in UPI versus like tier 1, tier 2, where you have tons of other options, right? So over the last sort of 24 months, the business has sort of shifted drastically. Today, like I was talking about top 15 cities accounting for 85%. Today, my top 30 cities account for like less than 40%, right? So tier 2, tier 3 is sort of completely taken over. And that's also reflective in sort of where we enable loans, where we enable investment products. And that's also sort of becoming more universal. Of course, some of the big tier 1 cities which adopted digital first, like Bangalore, Hyderabad, still leading the way. But no longer sort of the difference we used to see 2 years back.
Amazing, yeah. I mean, we're talking about last 2 years having made as you said, UPI mainstream, right? And in many ways, as I always call it, the digital silver line of the COVID dark cloud, right? So you can clearly see the implication out there. I mean, as a country, we touched the 100 billion USD milestone last year, right? And we are saying digital payments is expected to grow to at least 700 billion by 2025, right? Now, there is a very important factor that we see is expected to be playing a very strong role in that, which is BNPL, right? Buy now, pay later. And I know you obviously have a very important, that's a very important factor in your own model. So you want to talk about that, Suhail?
Yeah, so I think it's a very tricky topic to talk about. At one level, BNPL is nothing but a glorified credit card with EMI. I think how you enable it and how you run it is sort of very, very important to make it work, right? Otherwise, it becomes one more credit card story, which is nothing to shirk away, but it's not necessarily met the objectives which we probably as a country had set ourselves for, right? So still today, only 4 crore people have credit cards. That's not access to capital, and that's not financial inclusion in India's context, right? So if 3% of country has a credit card access, that's shameful after like few decades of credit cards being in the country. I think BNPL sort of has a very interesting opportunity to change that, right? So I think a lot of the card economics suffer because it's so reliant on network being present. It's so reliant on physical infrastructure, ability to ship cards, and given all the banks, all the sort of card providers are going after that same 4 crore audience, the activation rate of cards tends to be very, very low, right? So, and that suddenly makes the economics not viable for sort of card penetration. I think the fact that many of these card costs don't exist in a BNPL model, because you can, like our postpay app, you simply download the app and start using credit, right? I have no need to ship you a card. You get a virtual card in the app. You can use the same on QR as sort of credit on QR sort of becomes more mainstream, and the regulations on that become clearer. So both the number of stores you can use it at, because there are 2.5 million credit card terminals, there are 25 million QR code terminals, right? So both the number of places you can use it at and how many people can you sort of give access to, there is a huge potential to expand, right? So that's what excites me about BNPL. So BNPL done well and targeted towards what you call currently non-carded folks obviously needs a lot more thinking than just articulating on a video chat. Needs a lot better underwriting than what exists in the system. But if that is sort of cracked, I think it's a massive opportunity, right? So we could easily leapfrog the number of cards present in the market in like a couple of years if we as an industry get this right.
This is quite interesting numbers you said, right? I mean, we have 10 times the number of QR code terminals as much as the card terminals, right? I mean, that's quite interesting. And so in talking about underwriting here, Suhail, I mean, of course, the BNPL moves into the underwriting space of the consumer. But let's flip the discussion to the other side, right? The whole, underwriting of the merchant. I mean, industry estimates peg the small merchant, credit market anywhere around $1 trillion. I mean, it seems to be a huge market out there. And I know you actually have been, pioneering this discussion. So maybe you can give us a little bit of your own perspective on that whole market and how you see things unfolding there.
Yeah, so it's a massive market, whether it's $1 trillion, $3 trillion, $500 billion, I don't know. Very difficult to estimate. And this is just the last mile we are talking about, right? If you add the full chain, right? As I talk about a shopkeeper needs credit, but the distributor who's supplying to the shopkeeper needs credit even more, because the shopkeeper sometimes gets a 10-day, 15-day credit-free period from the distributor. No one is giving it to the distributor, right? So it's a huge market no matter how you look at it. The challenges in the market are 2, 3, right? One is, given the historical nature of the business and such heavy reliance on cash, and the fact that a lot of people have either not been liable for tax or have sort of evaded tax, for a lack of a better word. And there is no way to sort of basically say whether this guy is loan worthy or not, right? So that's the big challenge, right? So how do you underwrite a guy who has no formal history on credit and who's, if you go by conventional underwriting of his bank statements and IT returns, you will end up with a blank, right? So I think that's challenge one. The second challenge on this industry, and that's where I feel banks have never been able to sort of meet this demand, is the loan requirements are frequent but small.
Correct.
Right? So like a shopkeeper needs a 50,000 rupee loan, a 1 lakh rupee loan. He doesn't need a 10 lakh rupee loan very often, at least, right? So he needs a 10 lakh rupee loan when he's buying a house, when he's sort of setting up one more shop, which is easier to give because you have the asset to back it up. When he needs a 75,000 rupee working capital loan, a bank will never give it to him. And again, this is not putting it on the banks, they have their systems, but a bank finds it very difficult to give a small ticket loan, right? Higher likelihood of getting rejected if you ask for a 50,000 loan versus a 5 lakh rupee loan. Okay. That's just how the economics work, right? Because the cost of underwriting, the cost of all the processing and the cost of collection is a fixed rupees per loan. It's not a percentage of the loan value, right? Okay. So if the interest you earn is not even going to cover those three fixed costs and the cost of the infra, the loan makes no sense to you as a bank, right? So I think that's been the problem, right? So underwriting is one, but even if banks were to solve for underwriting, I believe they will find it very difficult to, in the conventional form, go after this market, right? So that's where sort of NBFCs came in. That's where sort of we came in. I think the problem with any NTC, and that's where we believe sort of our model helps a lot, is twofold. One is, can you underwrite the guy for his ability to pay? And then, given no formal history, are you willing to take the bet on his willingness to pay, right? So that's where sort of the payment network comes in, right? So I do believe BharatPe is able to help its NBFC partners disburse these loans at good collection rates, not because our underwriting engine is way superior. It's superior because I'm able to see the transactions, I'm able to see what money flows into his bank. But the reason the model is superior is because I'm able to collect or help my NBFC collect through the same cash flows, right? So, I actually believe underwriting is the more celebrated or worried term, whereas collection is sort of the main mode, right? And if you can do frictionless collection, if you can, for example, our product has a everyday installment, right? So consumer comes to the shop, pays for whatever he buys. At the end of the day, part of the money goes to the NBFC, part of the money goes to the shopkeeper. It just takes away the headache from a merchant's head of keeping X amount of rupees in his bank account towards the end of the month towards loan servicing. And that's not their nature, right? They're not just intuitively geared towards that. They see money in their bank account, they buy more working capital. Takes away that friction. The best lenders in the country, and like, for example, to me, Bajaj Finance is a incredibly good lender. Their bounce rates tend to be 15-16%, right? It doesn't mean NPA. It means it's the money they have to go after. In a model like ours, bounce rates tend to be 4-5%. Right. So that's where the advantage comes from. It is not necessarily the underwriting. I know that's not the answer a lot of people want to listen to, but I do believe BharatPe does well because we have good underwriting, but we have great ability to help our NBFC partners collect this money.
It's fantastic, right? I mean, the operating word, I guess, is frictionless, as you said, and making the whole experience for the repayment also somewhat intuitive and not necessarily you don't go through this rigmarole of actually making it. But that being said, Suhail, I mean, I know that underwriting is still, as you said, a celebrated word. So if I may still stick on to that for a minute, one of the things that you have the benefit of having, dealing with different types of merchant segments, right? I mean, you deal with large ones and small ones. You're dealing with medical stores and apparel stores. So, I mean, you do have over the period of time made some profiles or made some, let's say views on quote unquote, the ability to pay part, leave alone the willingness to pay, right? So you want to talk about that?
No, so I think, to be honest, I think this is very contextual, and we also started lending only 2 years back, or supporting lending 2 years back, and these 2 years have been chaotic, if anything, right? So, so people have gone through sort of waves and waves of COVID. I think to make sort of a long-term assumption based on that may be too premature,
Sure.
but at least in sort of our learnings during COVID was. Like we started over-indexing on what we call essentials, which is like the grocery stores, which is like the medical stores. And we started sort of over-indexing on categories which have a steady working capital flow, right? Which don't have sort of large capital cycles. For example, apparel can be very, very large cycles, right? 90 days. You buy inventory for the season and hope the season sort of you are able to sell it, and then you move on to the next cycle. But so I think we've obviously done a few things, but I think more importantly we've done things around some of the other geolocation elements of a merchant, right? So I think what we've seen is community angle works a lot, like in rural small ticket loans. If few people in the village defaults, the full village defaults is actually not very untrue for this category as well, right? So if you take a small market in Sarojini Nagar and 20 people are on loan, and they're performing well and they're sort of giving their money back, highly likely the next 20 merchants will also sort of perform in a very similar way, right? So so it's a bit of a category answer, is a bit of a unfortunate outcome of COVID. I would not argue, for example, in general, F&B is a great category to lend to because they need money, working capital cycles are short, product shelf lives are not very long, so money has to come back in. They're heavy digital already with the use of sort of Zomato, Swiggy's, etc. Most of them have a credit card machine as well as a QR code, right? So probably take 50 to 60% of their money digitally. Under any circumstance, I would normally say this is a great category to lend to. But during COVID, we realized this was the category which was suffering the most, because every time there is a wave, their business sort of goes through a heavy down cycle, right? So, so we may have taken some calls to, for example, go slow on categories like these, which probably over a period of time will reverse and come to what is sort of our normal expectations from a category which is as heavy digital and as short working capital as this, right? So, so I think the bigger point sort of around here is categories tell you something. Categories actually tell you a lot more about which category will ask for a loan versus not, right? So they may not necessarily tell you about the performance of the loan, but they will definitely tell you about this category is more likely to take loans and this category is more likely to take investment products. But geolocation tells you a lot more about sort of whether the person is likely to, how the person is likely to perform on his loan.
The community angle is a strong indicator of the willingness to pay, if I was to paraphrase it that way.
Yeah.
Yeah. So, but I mean, talking about the community angle here, right? One aspect that we've, as a country, we've been, aspiring to actually drive is the whole element of financial inclusion, right? In this case, more specifically, credit inclusion, right? I mean, if you view it from that standpoint, and clearly this is quote unquote a latent demand, unaddressed for various reasons. You talk about limitations of the conventional approach or the cost of underwriting and whatever, right? How do you see this in the future? I mean, the near future and the medium to long term future, Suhail?
So I think the great part, at least I've always, I'm still new to financial services, so I'm still learning, but my learning for the last few years has been sort of RBI is doing everything in its control. I have a lot of these debates on what can be done differently on regulations. Obviously, you as an industry participant, you will always have demands, but I think one thing we should give credit to RBI is they've been very thoughtful in letting experiments run. And obviously at some stage where the experiments become systematic, or systemic, they have to figure out how to regulate that so that it doesn't go out of control, right? And especially from the interest of sort of consumer interest and consumer fraud prevention and all of that. So I think last 5-6 years have laid down the backbone of what I call what will enable financial inclusion in the country, right? So UPI has reached everywhere. Digital banking licenses are being sort of talked about. We are obviously, along with Centrum as the main promoter, we have now a banking license. And as people like us set up banks, they will be by design more inclusive and more branch free in a way, right? And sort of, I think the combination of, at least my thinking is the combination of credit on UPI, the combination of BNPL, and the combination of branchless banking will drive the next big leap on inclusion, right? So how deep will we go? Will we sort of drive inclusion even in like small sort of towns, or towns definitely, but in small rural hubs? Time will tell. Sort of RBI's governance stance and regulatory stance will tell, but I do see credit inclusion at a minimum and investment product inclusion at a minimum, likely to go multiple fold over the next 4 or 5 years.
One definitely wishes so, and I guess today we are talking about India on the, as they say, edge of tomorrow. So I guess it can't get better than that, the way you just articulated. Suhail, we have a few questions from the audience, and I thought it may be appropriate that I also bring them on here.
Sure.
There's one question which is related to, since we're talking about regulations, there is this question from Devdutt Mukhopadhyay. He asks, do you think the upcoming data privacy regulation could make the merchant payment data for cross-selling or underwriting more challenging?
I don't necessarily think so. I think it is important to think about privacy in the right way. I do believe sort of many of the players violate the norms quite a bit. Like, so theoretically, when I'm doing a transaction, I can get also access to a consumer's phone number, bank account, etc., even though I'm not on the consumer side. I can also sell that data to sort of 5 players. I don't think it's appropriate, right? You are infringing on people's privacy. I think some of these norms will become tighter and tighter, which would mean at least one thing, which would mean sort of people with debatable business models and business models which infringe on very cheap access to someone else's data who doesn't want to use it will go down, right? So the product value proposition will need to be stronger and stronger. But I think the good thing about India is we have so many banks, we have so many NBFCs, and now we have at least 10 credible fintech players in the country. They already have enough consumer and merchant base that the word of mouth and the brand will keep on sort of expanding access and reach and scale, right? So it may become tougher for new players to drive the same level of scale as sort of we would have, because customer acquisition costs will sort of go up, right? And there will always be debate whether these customer acquisition costs can be sustained or not, right? So, but I don't think India necessarily needs tons of new players in these areas, right? Again, I'm not against entrepreneurship. I think there are 10 other areas in the financial space which need to be solved, and there will be companies which will come in those areas and solve it. But purely from if I think from a credit inclusion, investment inclusion point of view, and banking inclusion point of view, I think there are enough people at scale who will not face challenges because of these.
Got it. That, I guess, some answers that holistically, if I can put it that way, and one sees I think time will tell how many more new players we will have, but clearly the direction is, at least positive from where we are. There are a bunch of questions around BNPL here. So here, going back to the discussion we had, there is one question from Puneet Gajera, who's asking if micro lending is better or BNPL is better for the rural and tier 3 markets. And there is another related question from Manish Takwani, whose question is, what's your views on risks that are involved in the BNPL business as compared to, let's say, the unsecured lending business segment?
Yeah. So the risks are obviously higher. There's no question, right? So in an unsecured loan, I am underwriting you today for the tenure of the loan. On a BNPL, I'm underwriting you today for life, by and large. It's like a credit card, right? I'm giving you a credit card. I'm not going to take it away from you till you default. I think the great thing about the product is there is enough interchange income because it's eventually mostly a card transaction to cover for some of these inherent risks, right? So it's a higher risk, higher return product. It's a lot more convenient product. And typically you do personal loans, you don't do personal unsecured loans to buy grocery or buy buy like 5,000-10,000 rupee worth of like sort of a washing machine. You do them for sort of larger spends, and that's actually money taken to the bank versus money consumed on the go, right? So the use cases are very different. These are a lot more genuine use cases by design, because just because I want to fraud you as a consumer, I'm not going to start eating out on restaurants a lot more because I'm not getting that money, right? It's going on a consumption use case. So I think the intent to default, I would argue, is actually lower. It's riskier because I'm underwriting you for ups and downs in your life, right? So I think what we've seen in our BNPL journey so far, even though we've gone heavy new to credit, we've gone heavy what we call ETC, which is basically a category who are credited in the past but don't have a credit card. Like they may have taken a home loan, they may have taken a car loan, they may have taken a small unsecured loan. And what we are seeing is that in 3 months, sort of the collection cost or the capital cost or the loss, NPA, etc., is getting offset by just the interchange we are earning, right? So a cohort turns positive in month 4. I think that's part of the game here, right? So the simple thesis on BNPL, which I had heard, our numbers are much better, but what I had heard is, assume you acquire 100 customers this month, 5-6 will default next month, 3-4 will default the following month, 1 or 2 will default after that. Effectively, the 10-12% who've defaulted and have taken your money becomes the acquisition cost for the remaining 90. Those remaining 90 are golden for life, and you will keep making money on them, right? So our numbers are obviously much better for some reason. I think we've probably done something good on our underwriting. But even that 10% capital going down the drain, if it can promise you sort of income for the rest of the life, because this is a fee income product, right? You're earning interchange every month, is acceptable, right? Because like theoretically, if everyone had the same limit, 10 months you are break even, right? Because you lose 10% of your capital, every month you make 1% on interchange. So 10 months you're still break even, right? So it's a great product. It does seem intuitively more risky because of the profile of the product, but it gets supported by higher returns because of interchange, right? So that's one. I think that to the earlier part of the question, I definitely believe BNPL is the way. The cost of actually delivering a credit card into a rural town, like someone may be brilliant and do it at $100, including the cost of the credit card, but more likely is like $250 to $300. Right. Then the credit card activation rates are sort of 20% in the country. So you are effectively already at 1,500 rupees. Then the credit card use infrastructure in a rural area will not be big enough for you to earn enough interchange, right? So I think BNPL is the way. I think we also need government support in the form of enabling credit on UPI, because again, you can argue the card infrastructure, if it is a only carded BNPL, then the other challenges on card infrastructure not being present, POS machines not being present, is then a equally true answer for this also. If we can sort of enable credit on UPI in the right way, which I think, at least what I understand is RBI is thinking through, then the fact that BNPL costs you literally nothing except for the cost of download of an app, which is typically 5 to 6 rupees, to enable credit to someone, it takes away sort of a lot of the teething challenges or the upfront investments in sort of making this network work.
Makes sense. So short-term versus long-term game end of the day.
Yeah.
There's a very interesting question talking about the QR codes and going back to the small merchant. There is this interesting question from Pankaj Agarwal. He's asking you, how sticky are these small merchants with your QR codes? They keep shifting between various your views there.
No, that's a great question, by the way. Let me simply say a QR code is a QR code is a QR code. I may argue my QR code is better. I have better settlement rates. I have faster settlements and all of that. But that only you can basically prove if you're using everyone's QR code for an extended period of time. Otherwise, like payment failures do happen, right? So there will be one failure a month. Money will get stuck. And that's enough reason for you to say, BharatPe is useless. Let me move to someone else, right? I think what we've realized is when we launched the network and we were the first ones to make it free, obviously everyone was sticky. Now every QR code on paper is the same. I think what differentiates and what makes the customer stick is what else can you offer him, right? So, and that's where sort of we've seen that our merchants tend to be a lot stickier if they cross the 3-month barrier, because I'm literally the only one, plus Paytm to some extent, who enables them credit, right? Because PhonePe, Google Pay, at least from what we've understood, has no interest of sort of doing merchant credit. They may do buy now, pay later on the consumer side, but so far we've not understood any intent on the credit on the merchant side. Yeah. Who enables investment products for them, right? So, and some of us do, some of us do them better, right? Who enables them some of the other use cases like insurance? Who is sort of driving consumers to their shop? A lot of us can, but who is doing it, right? So I think the net of this is as long as the consumer, or as long as the merchant is only on a QR code, he is not sticky. I will not treat that as sticky. Once you go sort of QR plus 1, QR plus 2, and that's why we even launched the POS machine, right? Because we said, like, if you have a POS machine, then you will probably use the same QR because all the settlements, etc., will go to the same bank. That's why we enable credit through our NBFC partners, because as soon as the guy becomes QR++, then he's sticky, right? Till that time, you can't call him sticky.
So the operating word is QR++ there.
Yeah.
One last question, and I'll hand it back to Gitanjali. But this one is actually from Nitin Kanodia. And his question is, Suhail, what, in your view, is going to be the next innovation in payments we may witness post the QR code era?
It's very difficult to say. I think a couple of innovations, like we've discussed BNPL, so I will not talk about BNPL. A couple of innovations which are seeded but not really at scale today, which I think could be interesting. One is a tap-on phone. I think it takes away the same challenge we've been debating, right, on the infrastructure availability to enable card payments. And like we've been sort of toying with the idea, toying with the product. I think there is huge headroom because you convert, like, suddenly everyone has credit infrastructure, right? Everyone has credit card infrastructure overnight. I think that's probably going to be big. I think the second, which is still very nascent and you don't know which direction the regulations go on this, is blockchain and crypto. I'm not a big fan of crypto coins. I don't invest in a single one, but I think the underlying technology is fantastic. Think of, like, my view is cross-border transactions, which is a big part of a SME's life, especially distributors, wholesalers, traders, small manufacturers. They end up sort of wasting so much energy and money in the transaction costs, right? Using platforms, especially if it is a import-export transaction, then the currency loss, etc. You suddenly have stable coins, you suddenly have blockchain enabling that. it brings the cost literally to zero overnight, right? So I think how do we use the technology and what part of it we will use or not is still very unclear, and probably a couple of years before we become like sort of thoughtful about this. But I think that will make payments a lot more seamless. I think my core belief, and that's sort of where all these ideas are coming from, is payments is going to go to zero. Payment is a zero-sum game. If anyone believes they will make money on payments, I would not back that business model ever. Again, this is my view. I don't want to sort of impose others, but that's how sort of payments is the base layer on which everything is built. You can't be making money of that. I think like it became QR plus for us, it will have to become payments plus for all the players. And that's what we realized. And that's what Paytm realized. And that's why they're sort of getting into some of the other products. I think the sooner we realize it, I think the better it is for the ecosystem. And similarly, cross-border will go through it. Someday PG may go through it. Again, PG is a very different case because their payment enables commerce. First you do payment and then the transaction happens. Whereas in the offline world, transaction is already done. Now it's about which mode you use to pay, right? So therefore, like PG may come to zero, but it may come to zero last, right? But I think all the other payment modes, I do believe that the MDR interchange one makes will keep on coming down and start tending towards zero at some point of time, right? So products which are built on payments at the backbone and as low cost as possible, and on top of that you build other sort of innovative products where money can be made, are sort of the technologies I am at least backing.
So you see payments as the foundation or the layer that is actually enabling many more things to come, and therefore it becomes the bedrock in a way to actually create
a lot of people will start saying payments is my customer acquisition cost, I will offer it for free.
Wow, amazing. As they say, all good things need to come to an end. Suhail, I am afraid I have to hand this back to Gitanjali, but let me thank you. I'm sure the audience loved every word. They were lapping on everything you said. I enjoyed it so much, and thank you so much for your time again, Suhail.
Thank you, Ram. Take care.
मिनट में अकाउंट सेटअप और ट्रेडिंग शुरू।
हाँ कर सकते हैं।
नहीं कर सकते।
लगी शर्त और हारा तो It's possible with CoinSwitch Kuber. Download करो और Bitcoin trading start करो. CoinSwitch Kuber, सिक्का चमकेगा.
Cryptocurrency is an unregulated digital asset, not a legal tender and subject to market risks and price fluctuation risks.
Where there is life, there is hope, there is meaning. But life has its downs as much as its ups. Life is about challenges. Life is about opportunities. Time for joy, time for celebration, and time to introspect. Thankfully, in every one of life's moments, and even beyond life itself, there's LIC. Where there is life, there's always LIC. Zindagi ke saath bhi, zindagi ke baad bhi.
Welcome to Fego, a pioneer in the world of intelligent open finance. With our full-stack open finance platform, we enable companies to understand their users' financial behavior across various use cases, making finance engaging and actionable. Fago's developer-friendly product stack helps clients with friction-free user onboarding and authentication using trusted account information. Connect and aggregate your users' banking transaction data from any source, either any of the account aggregators or directly from any core banking solution at flexible intervals. Enrich and categorize transaction data using machine learning algorithms to extract deep behavioral attributes of your users. Understand and act on real-time insights powered by your users' behavior for a variety of use cases ranging from lending, wealth, income verification, frauds, to even branding and marketing insights. Engage with your users by embedding our personal finance management SDK in your existing user-facing app to push positive financial habits and personalize financial insights to your users. If you are looking to engage or understand your user base's financial behavior to take informed decisions, Faygo is your perfect partner. With the complete Faygo suite, you can now capture what drives your users at every stage of their journey and use it to drive your growth. Plug into Faygo and let us do the heavy lifting for you.